Since the end of 2022, we have had a significant bull run that appears to be going strong to this day, seeing just over 100% gain in the S&P 500. But a concern that many experienced and rookie investors have is what history has shown happens to stock market valuations when a major correction occurs, referred to as a bear market. Today, I'm going to show you how a contrarian investing strategy of buying underperforming stocks in a bear market compares to the S&P 500 when consistent stock purchases are made throughout a period. And it's probably not what you're expecting. We're going to test our theory on the three largest stock market collapses over the last 30 years, including the dot-com crash in 2000, the global financial crisis 2007 to 2008, and the COVID crisis in 2020. We're also going to run a test over the whole roughly 30-year period to show how this strategy fares. The dot-com crash is likely the closest parallel to today's AI boom, so definitely stay tuned for that later in the video. But let's first get our bearings with this graphic, which I'll use for all my comparisons. The list on the right is essentially the top 20 S&P 500 stocks just prior to the crash. The idea here is to choose a strong representative stock list. You can see a column with the header named last 12 months, and this orders the last 12-month return from highest to lowest. So the underperforming stock strategy, which is the picking loser strategy, essentially purchases $200 per month in the worst return percentage on that list, which will be at the bottom. We are testing two strategies against the underperforming stocks, the SPY ETF, which basically mirrors the S&P 500 index, and another scenario where we simply buy all 20 stocks equally. These two strategies also get the same $200 invested per month. Obviously, for the equal weight, it will be split between all 20 stocks. The line graph on the left and the strategy race on the top right show you how the portfolio tracks over time. And finally, the pie chart on the top left, which shows you which stocks are building up in the portfolio of the picking loser strategy over time. Now let's delve into the COVID bear market. We initially see consecutive purchases of ExxonMobil due to COVID sparking the largest ever crude oil drop in history, which the company derives the majority of its revenue from. So while we saw the underperforming strategy or the picking losers strategy lagging initially, now we see it go straight to the top with Exxon making a huge comeback, recovering from its previous prices. And for about 3.5 years, Exxon is carrying the majority of the performance for the picking loser strategy. Essentially what's happened here is Exxon has crashed 50%, while the S&P only dropped 33% during the COVID crash. This meant that Exxon was purchased during its bad run at a more heavily discounted price, leading to better return once the market recovered. Now, in Feb 2022, we had the Ukraine invasion. Now watch how Meta and Intel underperformed during this period, mainly due to loss in investor confidence. But these companies show a great recovery, further boosting the performance of the picking loser strategy. Proven with the last frame here, we see Intel up 459% on the previous 12 months. For our first test, we see the picking loser strategy comes out a clear winner. Now let's move to the GFC, the global financial crisis. And the picking loser strategy severely underperforms the SPY and equal weight strategies at the initial stages, with AIG getting absolutely pulverized. Essentially, AIG acted like the world's biggest insurer for mortgage investments, collecting premiums for years. But when the housing market crashed, everyone wanted to collect at the same time, and AIG didn't have enough cash to pay the bills basically. This is where they received a bailout from the government, saving them from bankruptcy. We also see Bank of America along with Citigroup declining during the crisis, making them prime picks for the underperforming strategy. These stocks eventually recover, boosting the picking loser strategy to the top. For our third test, let's look at the dot-com crash. This probably represents the closest conditions to today's bull market, mainly driven by tech companies. You can already see in the first month Qualcomm is up 1600% on the previous year, and Oracle just under 200%. Illustrating the incredible run by some of these companies back then, and somewhat comparable with the rises that we have seen lately from the likes of SanDisk, Nvidia, and Micron. As we begin the commencement of the bear market, we immediately see how the tech stocks start to see a dive, with Microsoft and Cisco quickly being bought up by the picking loser strategy. Shortly afterwards, we see a buy-up of Merck & Co. due to their sustained decline even beyond the dot-com crash, with poor stock returns until about early 2006. As we reach the end of the period, yet again the picking losers strategy turns out to be the best strategy. Now for the ultimate test. Let's cover a close to 30-year period going through all the key bear market cycles over the course of that time. Picking losers is very quickly leading with an initial buy-up in Procter & Gamble. Now you might be confused as to how picking losers is in the lead even though Procter & Gamble is still down on the last 12 months. This is because while the share price is down on the same time last year, the share price is still recovering month on month. Fast forward to June 2026, picking losers is marginally in the lead of the S&P index, which doesn't seem too impressive, but here's the astounding part about this. Picking losers was in the lead 255 months, while SPY only 62, meaning picking losers was in the lead about 4 times more of the time. Not only in this test, but in all 4 tests we've done so far, picking losers seems to be leading for much longer than the S&P, which is important. Why? Well, when these shares were purchased, the buyer didn't exactly know when they were going to sell. So in the light of uncertainty, the strategy that leads more often is likely to bring you a better return. Well, there you have it. We've done 4 historical tests, and it appears chasing underperforming stocks, which we've called picking losers, in the top 20 S&P 500 stocks tends to outperform an S&P ETF. But why? Benjamin Graham famously described the stock market as a voting machine in the short run, but a weighing machine in the long run. In other words, prices can sometimes move much further than the underlying business fundamentals would suggest, particularly during periods of fear and uncertainty. Let me give you a quick example using Meta. If you recall, it was one of the largest contributors to the picking losers strategy winning during the COVID scenario test. Most of Meta's purchases in the picking losers strategy was made around this period. Meta had a significant dip in 2022 due to concerns about its earnings. Its company earnings took a 45% drop between October 21 and about December 2022. However, over the same period, its share price dropped a whopping 77%. While there were certainly legitimate concerns surrounding the business, the fall in the share price was substantially larger than the decline in earnings. As confidence eventually returned, Meta experienced one of the strongest recoveries in the market, becoming one of the largest contributors, as I said, to the picking losers portfolio for the COVID scenario that we went through. But that doesn't mean every underperforming stock eventually rebounds. In fact, many don't. But history shows there are periods where investor sentiment pushes prices well below what later turns out to be justified. Thank you for watching. If you've enjoyed this video, please subscribe.